it's a good time to speak with Abizer Diwanji, founder at Neostat Advisors, and also get his sense of what we're setting up for. Abizer, thank you so much for coming in and speaking to us on the 31st. So thanks for your time. Just that quick snapshot that Vishwanath gave us as well, your take on that. It seemed like a lot of things which took time to move suddenly revved up in 2025 and came to a conclusion as far as the banking sector is concerned.
Yeah, I think a lot of it is driven by the individual at the helm, I guess. If you look at it, I think all of this has been handled pretty well. So one is you have regulation change. Now, regulation change is a responsibility in my view. If you allow people to do acquisition financing, if you ease up the rules, you blur the lines between banks and NBFCs, you allow more and more businesses to be done by all in respective entities and not make it exclusive completely. All these things tell you one thing, which is that today regulation is easing, but supervision needs to catch up. And what do I mean by supervision? Not necessarily regulatory supervision, but also governance supervision. And that's where we saw the likes of IndusInd, for example, happen. This is unfortunate, but we would only expect that more of IndusInd don't happen in the new year. But what I think the banking sector will do is the kind of capital that's coming is all responsible capital. It's coming from institutions, it's coming from private equity firms, or it's coming from strategics. And I think that capital will be deployed well. As you rightly said, the market has also kind of rewarded that because the market expects that the deployment of this capital is going to be rational. And that's extremely important for us. So I would think that we should not jump into acquisition financing just because it is allowed, but we should jump into it only once we have built the capabilities to do so. On the other hand, I think what we tend to forget, and that's the big thing that's happening, is even Vishwanath didn't refer to it, is the Avendus transaction. Mizuho comes and buys Avendus. Now, what does that do? That actually says that we are now having FDI come into the capital market segment, which is also a very important part of the financial services segment, simply because the liability side of customers is moving away from just bank deposits to actually more high yielding assets. So I must tell you the statistic. Though deposits grow at 10% per annum, 62% of banks' deposits are actually term deposits, which basically means that they earn higher yield. We have a shift that's happening from 60 lakh crores to 80 lakh crores moving to the mutual funds. 17 lakh crores of that being SIPs. And we are going to increasingly see more and more. The expectation is by 2035, we'll have 300 lakh crores come into the capital market segment. The capital markets then becomes an important destination for liability. The banking models will change. Deposits will be less important. We've heard most of the large NBFCs saying we don't need bank licenses. I'm not surprised because the lines between the bank and an NBFC, which was primarily deposit taking, has blurred a lot. What I see next year is RBI saying for large NBFCs, I want to offer a liquidity line. And once that is done, or allowed to do more payments, or allowed to do credit cards. Credit card is just a form of lending. Why would NBFCs not be allowed to do it? So I think some of these reforms, when they come in, you'll find that the lines between a bank and an NBFC blur significantly.
Right.
And when that happens, you will actually see a very, very intrusive financial services sector.
So, Abizer, good morning. Hiral on this side. We're talking about the way lines are blurring between NBFCs and banks, but this M&A financing that is happening right now is kind of for the first time, right? I mean,
Yes.
We are seeing funds that are particularly coming in from the Middle East and Japan and moving into the Indian financials in 2025. Now, with this influx that's happening, how do you see it affecting the landscape of these mid-sized private sector banks? Do you anticipate a wave of consolidation in the near future basis this?
I actually do. Because, in financial services, size will matter. And you look at the past performance. If you look at the small, mid-sized banks, whenever there has been a crisis, they have been vulnerable to it. If it was the MFI crisis, we had the mid-sized banks take the maximum hit. Their ability to raise capital went down. The cost of deposits was significantly higher. And this will continuously happen. You look at an RBL bank, and I give that as a good example, is a bank which is likely to migrate from being a middle tier bank to a large tier bank. They'll be able to match the size of a Kotak in terms of lending book. and they'll be able to do transactions which are in the syndicated nature. You mentioned M&A financing. They'll be able to do that because there will be an offshore balance sheet and there'll be an onshore balance sheet. Onshore balance sheet being equally strong. So at the end of it, unless banks build arsenals, and I see that in the Shriram Finance deal, they're building an arsenal for future growth. It has all the benefits: lower deposits, higher ratings, better ability to do larger ticket deals, everything. So I think mid-tier banks, I do either see a consolidation or I see strategic investments coming in over time. I also see a consolidation among the larger NBFCs and the mid-sized banks to make them much larger banks. So I think we are going to see a lot of consolidation in this sector across. And the last thing that I will say, and I come back to my capital market game, is that financial conglomerates will emerge. We already have them. Kotak is there, ICICI is there, SBI is there. We'll see many more large banks evolving into conglomerates because, as I said, liability lines are blurring. So it's better to take liability as well as create asset pools through AIFs, etc., on the same platform.
Okay.
So that's the consolidation for next year.
Okay, so that's the consolidation we're looking at. Abizer, as an investor, I know you can't give any picks or something, but as an investor, if someone has to look at the banking, financial, insurance space as a whole, okay, what are the key themes that one should be watching out for according to you?
So one is, of course, building scale. Which are the banks or financial institutions which would end up building scale? And those are the ones we should back. The others will be people who are going to diversify their existing book. You know, I've said this before, a lot of capital is coming in specific companies. If they continue to deploy that capital in doing much of the same, we may end up creating bubbles. And those bubbles will then result in a balance sheet which we may not like. I know we will not face something like what we did in 2015 because that was the corporate side of the balance sheet. What we will want to see more is that the retail NPLs are curtailed beyond our level. We don't want too much of lending happening there. So I would be wary of companies which do much of the same with the capital that they get. The third thing, of course, I will say is more and more people playing across the financial services spectrum. So the more the diversification of the group, the more I would want to say that those will be more sustainable organizations. As of course I said that I am not even qualified to give advice. I can't manage my own investments.
So capital markets is going to be one space one should be watching out for as well. But thank you, Abizer, so much for joining us on the show. It is 31st. Wishing you a happy new year and looking forward to speak to you in 2026 as well.